Hey everyone, it's Clay with the Burris Realty Group at Century 21 Sheets. Today we're back for another episode of BRGTV. It's April, and that means tax day is right around the corner on Monday, April 16th. So today we wanted to spend a few minutes talking about potential deductions for homeowners on your taxes. First of all, I want to start out by saying I am not an accountant. I'm a licensed real estate professional. We're just here to talk about some potential tax deductions for you as a homeowner. But before you file any of these, I would highly recommend you seek the advice of a professional accountant or tax preparer. That being said, probably the biggest benefit from a tax perspective for homeowners is the mortgage interest deduction. That's going to probably save you the most money, especially in the early stages, the first few years in your new house, because on the front end of a loan, you're paying mostly interest and very little principal at that point. So you can actually deduct the mortgage interest on that house off your taxes, which allows most homeowners to itemize and then qualify for other deductions above the standard as well. So that is by far probably the biggest and most important benefit of owning a house from a tax perspective. There are some other smaller ones that you may or may not qualify for depending on when you bought the house and what you're currently paying. But one of those would be points. If you paid points to buy down your interest rate when you closed on the house, some or all of those may be deductible for you. We also have the property taxes. So the property taxes you pay each year can be deductible in certain circumstances as well. And then probably the final one to hit on here is mortgage insurance. Now mortgage insurance comes into play if you've put less than 20% down. You may have mortgage insurance as part of your loan. And that's deductible up to a certain amount, but it has income restrictions. So I think it's if you make over $100,000 as a household, then that deduction goes away. So again, talk to your tax accountant for the details there, but that may be a deduction you qualify for depending on your income. Now, another common question we get when we help people with the sale of their house is, am I going to have to pay taxes on the income I'm making from the sale of the property? Again, speak with your accountant for full details, but in general, if you've lived in the house for at least 2 of the last 5 years as your primary residence and haven't used it for business purposes in any way, then the capital gains that you make off the sale of your house should be tax-free. Again, check with your accountant to make sure, but in most cases that rule will apply to you. So most of the time people don't have to pay taxes unless you live there less than 2 years or it's some sort of business type of property. Finally today, we just wanted to reiterate, as most of you probably already know, the tax code has changed quite a bit in the last 5-6 months. A lot of changes were put in place. So for next year's taxes, 2018 taxes filed in 2019, there will be a few changes to the homeowner deductions. Most of them very minor that probably won't affect the majority of people here in Central Indiana. But we'll check back with another episode on that. And but it is something to maybe ask your accountants about so for tax planning purposes moving forward. So hope you found a few pointers today about your taxes. Hope everyone has a happy filing, and hopefully most of you get money back. But be sure to check with your tax preparer. Again, disclosure, I'm not an accountant. Have a great week. We'll talk to you next time.